Welcome back to Whiteboard Finance. My name is Marco and I'm here to help you navigate the stock market, build your wealth, yada yada yada. You've heard it a million times. Let's get right into it. Today we're talking about the top 3 stocks that we should consider buying for November of 2018. Let's get right into it. The first stock is Alibaba. Alibaba is a Chinese multinational conglomerate specializing in e-commerce, retail, internet, AI, and technology. Alibaba helps connect manufacturers and suppliers all over the world. The manufacturers are typically in Asia and connecting to Western suppliers and distributors. Alibaba is a favorite among value investors such as myself because the stock is the definition of growth at a reasonable rate. The problem is that the stock remains in an intermediate downtrend below all of its key moving averages. So if you're a fundamental investor, Alibaba is definitely the stock to dig a little bit deeper into. The long-term investment thesis for Alibaba is pretty simple. This is a company that dominates e-commerce and online retail in China, and it's the largest growth market in the world, even though their economy has slowed down a bit over the past few months. But here is all you need to know about Alibaba, and this is why I'm recommending it for November of 2018 and moving forward. Since 2015, Alibaba's online sales and profits have surpassed all US retailers combined. That's including Amazon, Walmart, eBay, all those big players that you see online. Alibaba does that with no sweat. So when a company like this has a stock price selling at 20 times forward earnings, that's actually an extraordinary bargain price in my humble opinion. So in my opinion, Alibaba has massive future growth potential in the years ahead. If you have the stomach for it, make this a part of your portfolio and hold it for at least 5 years. That's pretty much what I'm going to do. I'm going to set it and forget it at this price. It should produce massive gains over those next 5 years. And analysts tend to agree with me. Right now, Alibaba is trading at $142.93 per share. And out of all the analysts that I follow, 13 of them have strong buy ratings on Alibaba with a target price of $227 through next October of 2019. This is a 58% upside in the stock. So overall, I'm confident in Alibaba. Of course, every stock has some kind of risk and there's going to be ups and downs here over the next few years. But one of the biggest reasons why I like Alibaba, and just to conclude on this stock, is that it gives you exposure to Chinese and Asian global markets, and it's actually a lot less risky in my opinion compared to all the other popular or hot Chinese stocks being talked about on YouTube and the internet in general. It comes with enormous growth potential on a multi-decade timescale, so Alibaba, in my opinion, is here to stay. Number 2, Activision Blizzard. So Activision Blizzard is currently trading at $69.75. It's on a little bit of a dip here at the time of this recording. Out of the analysts that I follow, 11 of them recommend it as a strong buy, 1 as a hold, and eventually a target price of $85 over the next year. That means a 22% upside. So I'm going to give about 10 reasons here as to why I like Activision Blizzard, so bear with me, these are all important points. The first reason why I like Activision Blizzard is because interactive entertainment is growing. Several trends have come together in recent years that are benefiting game sales, including game streaming, mobile games, and obviously esports. The industry is expected to grow 11% per year by $180 billion by 2021, and that's an excellent tailwind for Activision to have at its back moving forward. Reason number 2, gaming is getting more popular every year. This is inevitable. With every passing year, more and more people are playing games. The percentage of the general population aged 13 and older who play video games has steadily increased from 58% in 2013 to 66% in 2018, according to a Nielsen survey. This is pretty interesting because I'm 30, and a lot of my friends who are in their 30s, believe it or not, are still playing video games. So I thought that was pretty interesting. I have nothing against video games, but I think that's an excellent indicator for future growth for Activision Blizzard. The third reason why I like Activision is because of the diversified game roster. So Activision owns one of the biggest franchises in the industry, including Call of Duty, Overwatch, World of Warcraft, and the super addictive game, I can attest to this, Candy Crush. So Activision boasts about 352 million monthly active users who spend an average of 50 minutes per day playing its games. Number 4, it is a cash machine. With millions of players spending nearly an hour every day playing its games and spending money while playing, Activision has built itself a virtual printing press of money. Over the last year, Activision generated $7.3 billion in revenue and $1.9 billion with a B in free cash flow. The 5th reason why I like Activision is because of the dividends. Activision's free cash flow generation allows it to pay a regular dividend. Currently, the dividend yield is just about 0.42%, which is not high by any dividend investor standard, mine included. But Activision has more than doubled its dividend payout since initiating a dividend in 2010. It only pays out a small fraction of its annual free cash flow, so there's definitely potential for the dividend to substantially grow over time. Number 6, big margins. So anybody that follows technology in general knows that they operate on fat margins. So bringing a game to market is relatively cheap for a company like Activision. It may spend a few $100 million to bring a game to market, but a big title like Call of Duty or any of those other games that I mentioned like World of Warcraft or Overwatch, it may take only days or weeks to recoup those costs. So the operating margins are extremely fat. Number 7, they aren't reliant on one-time hits. So game companies have been lengthening the life of certain titles by releasing add-on content that gamers purchase while playing a game. This means that titles can generate revenue for months or years in some cases. So 2 examples are World of Warcraft, which I used to play in college, this was almost a decade ago, and Overwatch, in which both titles remain 2 of the company's biggest revenue generators. Number 9, and in my opinion, one of the biggest influencers of this stock going forward, is that esports is going mainstream. So esports is already looking like $1 billion business for Activision. Overwatch's League of Grand Finals sold out a 20,000 seat capacity arena and was aired live by ESPN and Disney's XD channel. That is crazy, you guys. If you would have told me when I was a kid that people would be filling up arenas to watch someone else play video games, I would have never believed it. So attendees noted that a level of excitement in the arena rivaled traditional sporting events. Activision is well positioned for what could become a major new form of entertainment in the 21st century. This is kind of like Ready Player One coming to life, in my opinion. Finally, reason number 9 why I like Activision is that they have a CEO that's focused on profitable growth. CEO Bobby Kotick has made some game-changing deals in the last decade. Activision would be a fraction of its current market value if not for the Activision-Blizzard merger in 2008, the buyback of Vivendi's controlling stake in 2013, and the acquisition of King Digital Entertainment in 2016. These transactions significantly increased the company's free cash flow per share and brought under one corporate umbrella major gaming franchises such as World of Warcraft and Candy Crush, both of which I've played, so I can attest to their addictiveness. Finally, stock number 3, get in the zone, AutoZone. Okay, I'll never do that again, sorry. So AutoZone is currently trading at $725.80 a share at the time of this recording. Out of the analysts that follow it and that I follow, 4 recommend it as a strong buy and 2 recommend just holding it. They have a target price, listen to this you guys, of $843 per share over the course of 2019 with a 16% upside. I think that's pretty interesting. So if you guys live under a rock or if you don't live in one of the countries that AutoZone lives or plays in, AutoZone is actually the nation's leading retailer and a leading distributor of automotive replacement parts and accessories with more than 6,000 stores in the United States, Puerto Rico, Mexico, and Brazil. So AutoZone may not seem like a cool and fun, interesting business like all these new tech stocks and IPOs that are coming out, but for me it's solid and boring, which is kind of the type of investor that I am. It generates a ton of cash as well, and that's the biggest reason why I'm recommending it for November of 2018. It's what AutoZone does with that cash that makes it very appealing. So AutoZone has been a long committed and aggressive share repurchaser. So if you don't know what stock buybacks are and why they're a good thing, I will definitely be making a video on that on this channel shortly. AutoZone has reduced shares outstanding by 4.2% in the last 12 months. AutoZone has been one of the most aggressive share repurchasers over the last decade, choosing to buy back shares and to return value to its shareholders instead of paying a cash dividend. So I'm kind of torn on this because I do enjoy investing and receiving dividends from the companies that I invest in, but at the same time, the next stat will actually blow your mind. So in 2008, AutoZone has spent about $12.4 billion in share buybacks. So for comparison, the company is only worth, or has a market cap, well, not only, but it has a market cap of $21 billion. AutoZone decreased its shares outstanding by more than half and has never repurchased less than 4% of its shares annually during this period. So if you would have owned AutoZone in 2008 and held on to your investment, you would own twice as much of the company, enough to sell more than 5% of your investment every year while keeping and growing your initial investment. So you're kind of just skimming off the top because they're removing the shares outstanding. AutoZone plans to open distribution centers, and it's investing in the development of mega hub stores. So ticker symbol is AZO, which I forgot to mention in case you're interested in looking this up. But AutoZone opened 2 new mega hubs during fiscal year 2018 in quarter 1 as part of its plan to open about 10 of these hubs all throughout 2018. Management has noted that its sales at its mega hubs has exceeded expectations in this quarter, and that's why AutoZone is likely to continue to focus on its mega hub expansion strategy to boost sales going into 2019. So to continue harping on AutoZone's buyback theme, during quarter 1 fiscal year 2018, AutoZone repurchased 597,000 shares of its common stock for $353 million at an average price of $590 per share. I expect the share of repurchases to continue at AutoZone as it's now ingrained as part of the corporate culture. You're getting a lot of value here in this stock because it's a rock solid company that has a lot of cash, and they just continue to keep buying back their stock. So there's going to be a lot of value moving forward. Even though AutoZone hasn't been the most stellar performer, I think this will also be a staple in any portfolio moving forward. And just a quick note, you guys, I don't know if you remember the recession of 2008. A lot of people don't go out and buy new cars or even used cars during recessions. They just continue to fix and repair their current cars because in the short term, it's actually cheaper to do so. So any franchises like O'Reilly's, AutoZone, any of those local repair shops, they're absolutely killing it during a recession. So that's why I recommend AutoZone for November of 2018. So there you have it, everybody. We have Alibaba, Activision Blizzard, and AutoZone for the 3 stocks to consider purchasing in November of 2018. If you got any value out of this video, please hit the like button and the subscribe button. I really appreciate it. And if you haven't seen this already, I will be sending out an email of a weekly stock that I recommend going forward. So check out the link below in the description. Feel free to sign up at no obligation. It's absolutely free, you guys. Thank you so much for watching, and have a prosperous day. Please click the big red button to subscribe. It really helps me when you do that. And click the bell for notifications so you never miss a video.